Hi, I'm Sean Dawson, Head of Insights at DeVono Cresa. I'd like to take this opportunity to have a look back at Q3 in the central London office market, especially as the end of the year is now in sight. Headlines from our research include strong leasing demand, falling availability, and stable prime rents, all striking a familiar tone with our previous research throughout the year. Leasing demand in Q3 has been strong. It's continued the same trend as we've seen not just throughout this year, but the past 7 quarters. 2.8 million square feet was transacted. Although this is down on the 3.8 that we saw across Q2, it's still in line with the long-term average. The total volume of office space that has been leased in 2018 year to date is 9.5 million square feet. This is the same level as where we were at the same point in 2017 and also 2014 and 2015. 2018 is turning out to be the year of the supersized deal. No sooner had the ink dried on the Chinese embassy deal at the Royal Mint Court than we're seeing Facebook sign up for 600,000 square feet at the King's Cross site. So this year alone, we've seen 10 deals of over 100,000 square feet transacted. And this is not including the deals that have taken place in White City, where we've seen Publicis take 212,000 square feet, and also eastwards over at the Olympic Park here east, where the V&A Museum have taken 145,000 square feet. So which parts of the business community have been driving leasing demand? Well, the technology sector, with 37% of the total of Q3 take-up, has definitely taken the lion's share of leasing activity. The financial sector has notched up 13% of take-up across the quarter. This is marginally down where we were at the beginning of the year. Nevertheless, the financial sector is still a key driver of leasing activity within central London. One of the largest deals from the financial sector this quarter was 122,000 square feet pre-let at 55 Gresham Street by our own client Investec Asset Management. Yet it is the corporate sector that is driving demand as a whole throughout 2018. And if you look at it in a little bit more detail, it's the serviced office providers that come underneath this umbrella of corporate that have been giving this sector a boost. Accounting for 12% of all take-up this year, the race to gain more coverage by these service providers keeps apace, and we expect to see this continue throughout the rest of the year and into 2019. So it seems as though the trend for this year is in addition to the big buildings, it's the shiny and new buildings. And if we look at the leasing activity in a little bit more detail, we see that 29% of leasing has been by way of pre-let or early let, so this is letting during construction. Couple this with the amount of Grade A space that has been taken as well, and we're roughly around 50-50 Grade A early let against second-hand space. There is a price point to all this, and tenants throughout this year have been able to achieve favourable rents and incentives on some of the best-in-class space in central London. So availability has fallen once again this quarter, down to 15.4 million square feet, which is a 6% drop on the previous quarter. Now down to an availability rate of 6.2%. And this drop that we've seen is the largest drop since 2015. So the falling levels have been driven by a reduction in space available in the Midtown market and also south of the river in the South Bank market. So despite the fall in availability levels across central London, there is starting to be a bit of a disparity in terms of the size range that's available out there, and there is a squeeze at the top end of the market, but nevertheless there's still a significant amount of space that is out there, and at 15.4 million we're a far cry from the lows that we were seeing in 2015. So over the past quarter we've seen roughly around 1% rental growth for prime Grade A across central London submarkets. Over the course of the year, this roughly equates to around 3% growth, which is relatively subdued. However, there are certain movers and shakers, so if we look out into eastwards, Hackney, Dalston, we've started to see rents tip over £40 per square foot there. Soho, £97.50, which is a new high. Clerkenwell and Farringdon, we're starting to see rents of £80 per square foot being commanded in that particular area. So we are seeing some pockets of rental growth. Equally, we are seeing some pockets of rental decline. So Victoria, we've already seen a decline in Q2 going into Q3. Hammersmith, Grade B rents have been chipped away at. So as we head into the rest of the year, we do expect to see some rents starting to be reined in a little bit. And in 2019, we expect to see the same picture. So the strength of demand for London offices is still out there. As we head into the final couple of months of 2018 and heading into 2019, we've recorded 4.1 million square feet of office space under offer, 1.5 in the city, which is up 17%, 1.2 in the West End, which is up 70%. This clearly highlights that there is a pool of demand that is still out there. It might not complete by the end of the year, but what we are expecting to see is that total level of take-up for 2018 will match, if not surpass that in 2017. Busting a myth that the economic, political, Brexit jitters are kind of stalling businesses' decisions to move into new spaces. But what it is doing is forcing tenants and businesses to make those real estate decisions and to plan ahead regardless of the circumstances that are arising. So I've just touched on a few brief points that we have featured in our latest Occupier, and if you want to find out more about what's happening in the central London office market either now or going forward, please do give us a call.